Hello, Professor Karn back with you discussing more on internal control. Today we're going to talk about a bank reconciliation. And a bank reconciliation really is trying to make sure that we reconcile the items between what we see on the bank statement, which is referred to as the balance per bank, and then our cash account, which we'll refer to as balance per books. So we need to make sure and focus on things that we don't know that the other side has done, and then we have to update the record accordingly. So let's see how this works. Let's say that we wrote some checks and mailed them out on the last day of the month. Well, in all probability, if we mailed them out, they are not going to be reflected on the bank statement that ends that month because they would not have cleared the bank. So the bank would be unaware of any checks that we wrote that are outstanding until they do clear. So that's just one example of something that wouldn't be known. So those are the types of things that we're going to have to look at. Let's say the bank collected some money for us on our behalf. Well, we may not know that until we look at our bank statement and see that they did that. So it's really an exercise of figuring out what is not known by each side and dealing with those situations. Now, the adjusted balances at the end must equal, and if they do not, then there is a mistake. And then we need to do, for the book side, we need to do journal entries that update our cash account accordingly. We would not do any journal entries for the bank because they would be responsible for doing them on their own. Okay, so let's see what we have here. I have in Excel here for you a little document I use in class quite a bit. And really what we're looking at here is how you would set this up. You would have the business name at the top here. Let me make this bigger. So you'd have the business name there, your bank reconciliation, and then for your specific period there. And then we'd have the balance per bank side and the balance per book side. So let's go through each of these sides and see what potentially you could have to put in these areas. Now, just because they appear here doesn't mean that every problem will have them. This is just a generic overview of what you may find. Okay, so let's say that we made a deposit on the last day of the month and it didn't make the bank statement at this particular period. Well, we'd have to make sure that the bank, on the bank reconciliation, that we updated it accordingly. So any deposits that do not make it onto the bank statement that we made would be referred to as a deposit in transit. And then, like I said earlier, any checks that we write that have not cleared the bank and are not on the bank statement would have to be subtracted as outstanding checks. Now, if the bank would accidentally subtract money out of your account by mistake, that would be referred to as a bank error, and they would have to add it back in. Another example of a bank error would mean if they actually added money into our account by mistake, well, then they would have to subtract it out. So it would just depend on the circumstance whether you would have to add the bank error in or subtract the bank error out. Okay, moving over to the book side, you want to take a look at some basic things here. These are the things that we would see here that we could add in. A bank collection of anything on our behalf, so if they collect money for us on account, or if someone just dropped money off to pay their bill, the same type of situation, that would be a bank collection. Now, an EFT stands for electronic funds transfer. We could get money via EFT, and we'd have to, if it increased our account as far as money coming in, we'd have to figure out what that was for. The bank could pay us interest, and on the bank statement we could find that we earned interest revenue and they added that in. You could also earn dividend revenue. So either one of these things you would earn from the bank, or depending, let's say you had stocks, an investment in a stock, and they paid dividends, they directly put it into your bank account. You would add in the dividend revenue, same type of thing. Now, as far as what we would subtract, EFT payments, electronic funds transfer, if we pay something online and it comes out of our account, that would be a subtraction. The bank could also have a service charge for us to have our account, so that would be a subtraction that we'd have to make there. And then what happens if someone bounces a check to us? Well, that's an NSF check, or non-sufficient funds check. So we'd have to subtract that out because we would have already included that as an addition to our cash account. And if we got notification from the bank that it bounced, we'd have to reduce our cash account by that amount. Now, what happens if we make a book error? So the way that I would approach this, and seems to be, I think, kind of like the best way to go as far as getting it right most of the time. If you have a book error, let's say you wrote a check for $590, and the check was sent in, that was what it cleared for, but you recorded it as $950, meaning you made a mistake, a book error. Here's how to get it right all the time. If you always add in the incorrect amount of the book error, you do that, and then you subtract the correct amount. So you would do both. That's why I have this 1 and 2, and it's kind of joined here. Always for a book error, add in the incorrect amount and subtract the correct amount so that you get this right 100% of the time. The one thing that you have to be careful of is, in my accounting lab, you may see this only have one space for one thing. They don't take this approach. So what I would do is, on kind of off to the side on scrap paper when you're working in my lab, do this calculation and always say, so start off with the incorrect amount, subtract the correct amount. If it's a positive number, you would have to add it. If it was a negative number, you'd have to subtract it. So just kind of keep that in mind and go from there. Then once you add all these totals up, you put your balances in here, your beginning balance on the bank statement, the ending balance on the bank statement, and your current balance of your T account of cash. You take into account all of these things here, and then in here, and then the total should be the same. So let's take a look at a problem in another video on how to do an actual bank reconciliation, and then also the journal entries for the book side that are associated with that.